Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs, and today we are diving into the world of fixed income. It's been a while since we covered this topic on the channel, and this year we've seen interest rate expectations really continue to shift, and investors are rethinking their strategies as this landscape continues to evolve. So joining me is Matt Montemurro, Managing Director and Head of Fixed Income and Equity ETFs here at BMO ETFs. And we're going to talk about everything from why cash-like products are still in demand, and we're going to explore how duration and credit selection are really going to shape portfolios for the rest of this year. Just a quick reminder that we're not providing any investment advice or recommendations. Today is all about education and information for Canadian DIY investors. Matt, great to have you back on the channel. Hope you're having a good summer so far.
Thanks, Erin. Yeah, thanks for having me. And yeah, great summer, and look forward to diving into this topic today.
Good stuff. Yeah, let's get right into it. We've seen a lot of investors really parking cash, it seems, in high interest savings, money market, sort of that ultra short term end of the curve over the past couple years now. And we've seen persistent flows. So can you walk us through why we're seeing this trend, even as we've seen rate cuts starting?
Absolutely. This has been one of the biggest shifts in investor allocations over the last several years. As rates peaked, investors looked at the trade-off between being invested in the short end of the curve and investing further out the curve. And really, it was a no-brainer to capitalize on the inverted yield curve and achieve an attractive yield. At some points, it was over 5%, and at the same time, reducing downside risk within their portfolios. So, that was a very, very common trade that investors took advantage of. What we saw, let's say, 2023 to the present. As rates in Canada have started to come down, we've seen some consistent rate cuts by the Bank of Canada, 5% to 2.75 now. Those cash allocations, they've remained sticky, and investors have been slow to reallocate throughout the curve, across the curve, and back into the markets. And really, I believe that rationale is twofold. One, at 275, investors are still earning well above the 10-year historical averages for yield to maturity. So, given the volatility in the markets, the trade-off between a historically attractive yield while sitting out some of that market volatility, it's a good trade for a lot of investors. And I do believe that if and when rates continue to come down, we will start to see that migration out of cash. At some point, you have to think that investors will have to reallocate because the yield that they're earning in the portfolio will not be enough to meet their underlying needs. At this point, it's still been sticky, but we're waiting to see that inflection point. And I do think it's going to be coming kind of, let's call it within 2026, we'll start to see that redeployment of cash. That second reason, that second rationale that I was talking about is we continue to sit in a period of heightened volatility. A period where the yield curve has already started to normalize in Canada. So it's an environment where rates, which were expected to fall, have not fallen uniformly. So we've seen short-term rates come down, but longer-term rates have actually gone up. Some of that is because of that yield curve normalization after we've had a prolonged inversion of the yield curve following that spike in rates in 2022. But some of that also is an increasing of term premium. So, which is created by, our favorite word, tariffs, global trade uncertainty. This has made duration, longer term risk a very, very tricky proposition for a lot of investors. And to be honest, probably too much risk for a lot of investors that are willing to take. So that's something that I think is affecting the psyche of investors right now in the cash on the short end of the curve. And I do think that that's something that we'll need to see volatility come down, a little bit more certainty in markets before we really see that redeployment out of cash.
I like that. The three: tariff, trade, and maybe more generally Trump. The three T's that are impacting it. And you mentioned 2.75. That's sort of like the average money market yield right now. Is that where we're sitting?
Yeah, well, that's the overnight rate. So generally, you'd see money market, short-term fixed income. Let's call it, 10 to 25 basis points from that overnight rate of 275.
Gotcha. Okay. And then let's talk about sort of the shift that we've seen in interest rate expectations and how that's shaping investor behavior. Maybe you touched on this, but maybe there's a bit more to go on that.
Yeah, absolutely. So, I think we all remember, we probably want to forget 2022 was an extremely rough year for investors. And this was both sides of the portfolio, equity and fixed income. Rates rose rapidly. I think the pain that was incurred by investors has led a lot of investors to seek safety and reduce risk on the downside within their portfolios. Willingness to take risk, I think, has really come down, especially on the fixed income side of the ledger. So coming out of this, I think it was quite obvious there was an opportunity in the short end. There was little to no duration risk, 5% yields, something we hadn't seen in decades. So many investors took that path of least resistance and said, hey, if I can maximize my yield and lower my risk, that's a winning trade. And so that's how we saw the allocation of short-term money really come to play. What we're starting to see now is, changing of those expectations, changing of that volatility, but that money has remained sticky. And I think partially due to that increased volatility. You just said the three T's, that is something that is concerning investors. And that is not something that I think we would naturally think about within our fixed income context. So it's a new risk within the portfolio. But I do think a lot of investors look at it and say, well, at 2.75% or 3% yield, I still meet a lot of my income needs. It's still higher than I've earned over the last 10 years. There's little to no downside risk. So it's a tough trade to pass up. So, in a world where I think rates are expected to be range bound from here, I do think a lot of investors will view cash and short-term fixed income as a viable alternative within their portfolio context. So I do think investor expectations have changed versus maybe 5 years ago, where we were in a much lower interest rate environment. But I do think that if we continue to see some cuts, 2026 will be a year where we're really starting to see investors have that inflection point and say, okay, now it's time for me to be more traditional in my fixed income positioning rather than just hugging the short end, which has been the trend and the winning trade for that matter for quite some time.
All right, good stuff. So before Matt was running sort of the fixed income and equity index ETFs at BMO ETFs, he was really specifically focused on fixed income, which is why I'm always bringing you back to talk about this. But I want to hear from you sort of what are the key themes that you see that you're watching for the remainder of this year when it comes to fixed income?
Yeah, absolutely. So, tariffs, again, I don't think you can have a conversation these days without having tariffs be basically the main headline. That has made headlines in 2025. And I think it's going to be the theme now and will continue to be the theme and the driver of markets for the rest of the year. With that said, everyone is now looking at the Bank of Canada and the Fed. What's their next move? Who's moving next? How does it impact each other? I think if you look at economic data, it's already slowed in Canada, and the cracks are starting to show in the US. We saw some poor data in the last several weeks, and the cracks are starting to be meaningful. Trump has started to put pressure on the Fed. He wants rates lower, obviously. He wants to continue to see growth in the economy. So it is going to be very interesting over the remainder of 2025. How does that play out? How does the Bank of Canada, look at the US, look at the Fed, and how do they react? So if I'm looking at my Canadian context, I have my Canadian hat on, the Bank of Canada has already paused their cutting cycle. We went from 5 to 275, as I said. Now they're in wait and see mode. I think they are waiting for some more data to come out. How impactful have tariffs been? How impactful have they been to inflation, to growth, to GDP? I think we're starting to see some of that, but I think the Bank of Canada really wants to see over a prolonged period what that lasting impact is before they potentially cut too fast, too soon. So that's what they're really worried about here. Right now, if I look forward, In Canada, I see the markets pricing in about an 89% chance of only one more cut for 2025. So this was less than we expected, starting the year. But I think given the unexpected rise in tariffs and basically global trade uncertainty, I think it's something that would be prudent to look at. The other factor, though, it's always impacts Canada is what are they doing south of the border? Data continues to show cracks, market expectations, the Fed just they start. When will the Fed start their cutting cycle? Right now, market's pricing in September, and they'll end the year with 2 cuts. I really do think this will be a balancing act in what could be a stagflationary environment. I do expect there to be political tension between the Fed and Trump. And I do think that is something that will be a meaningful theme as we look throughout the year. So I look at it's Fed, it's the Bank of Canada, and it's really to see when they start cutting, how quickly will they start cutting beyond anything else.
Okay. And you mentioned short-term rates coming down, long-term rates going up. Why do we think investors still seem to be very hesitant to move out along the yield curve if we've looked at flows and we just got the latest from National Bank, I think today, but why are investors so hesitant to move out? Is it all these risks?
It's definitely a huge component of it. What we've seen this year in Canada is the continued lowering of rates in the short end, but again, longer term rates have risen. So that's a combination, again, normalization of the yield curve, right? We were inverted yield curve for a long period of time where shorter term rates were higher than longer term rates. Longer term, you would expect it to be the opposite. So there is going to be a little bit of normalization where longer term rates do have to normalize. So you get an upward sloping yield curve. That is definitely happening. But I do think that risk premiums, global trade, all of these factors that we've discussed have led to greater risks, either Canada and globally, and has led to longer term rates going up. So this year, duration, even though you would have thought that in a period where Bank of Canada has cut several times, duration would have performed well, that normalization, that global uncertainty, that the tariffs being implemented across the board, duration has continued to be a challenging and difficult thing for investors to time. And I think that unpredictability in markets has made the long duration trade a very challenging one. And a lot of investors kind of saying, you know what, this is not for the faint of heart. This is something that I don't want to deal with in the near term of my portfolio. Again, if I can get 3-ish% in short-term fixed income, that's not a terrible trade. So I think a lot of investors are taking that path of least resistance and saying, I'd rather wait this out, see where things go, hug the short end of the curve, and basically minimize the volatility or downside risk within my portfolio and make decisions in the future, whether it's later this year, whether it's 2026. I do think that the theme of 2026, if we continue to see now Bank of Canada and Fed both firmly on the cutting cycle, I do think that duration will be something that a lot of investors will be forced to reconsider next year. I would have thought it this year, but tariffs kind of slowed that cutting cycle in Canada. So I do think that is a 2026 topic that I think will be very topical.
Yeah. Okay. So let's talk about specific sectors or types of bonds, corporates versus govies versus high yield. Where are we seeing the flows? Where are we seeing the interest right now?
Yeah, we continue to see interest in yield enhancement. I think that's probably the thing I talk about the most. As such, I think corporate bonds, they've driven most of the flows that we see. We ZST, our ultra short-term bond, is a credit focus. ZCS, which is one of our fastest growing funds this year, also short end credit focus. So corporate bonds is definitely where I see a lot of the flow. That's where I see a lot of the interest in the market right now. If you look historically, credit spreads do look extremely tight. In month over month, we see and say, okay, these spreads continue to drive tighter. So some of that is structural. Again, since 2022, a lot of investors, institutional and retail, had a lot of cash sitting on the sidelines. So a shortage, we've seen a little bit of a shortage of bond supply, issuers not issuing as much as they may have in the past. Higher interest rates make it more expensive to borrow money. Therefore, a little bit of that supply shortage has led to investors having cash on the sidelines ready to deploy. What that does is it keeps credit spreads tight, keeps volatility low in what would be generally more volatile asset class, which is corporate bonds and corporate fixed income. In terms of the type of credit, we can definitely see investment grade credit versus high yield. Again, I think that volatility, it spooks a lot of investors. And at 275, there's a big difference. When you were at 1%, investors needed that extra cash. So they needed to go down the credit curve to get high yield to boost their yield. At 275, they don't need to take those risks anymore. So what we are seeing is investment grade credit. We're seeing a new ETF that we've launched, ZAAA, which is our BMO AAA CLO ETF, offering investment grade AAA credit, but with a yield enhancement. So, we're seeing investors look to alternatives that are higher quality, but still get the yield enhancement or the income enhancement that they're looking for within their portfolio.
Okay. And we've seen from the flows, HISA ETFs sort of come off, but money market, in particular, BMO's money market ETF, ZMMK, continues to really top the charts almost month after month in terms of flows. So talk to us about that ETF. And also, we saw a special distribution last month for ZMMK that I did see some questions on Reddit. So maybe you can just cover off what is a special distribution and what does that mean for investors too?
Yeah. So, the ZMMK trade, in the same reasoning as we've been discussed, investors continuing to hug on the short end. And ZMMK has been one of the biggest benefactors of this trend. We've seen the growth in ZMMK, like you said, month after month. That ETF is now over 5 billion. So if you look 5 years ago, that is tremendous and staggering growth. And that just shows that not only are investors hugging to the short end, but they're using the ETF as that cash vehicle, both retail and institutional. So that kind of retail versus institutional, that's where this special distribution comes in. So last month, something unique happened. A special distribution was announced and distributed mid-month. So that was outside of that normal monthly cash flow that investors have grown to expect with ZMMK. So let me walk through in general why a special distribution is granted or would be granted. So often when there are large holders, usually these are institutional investors that own an ETF and are a large percentage of the ownership, let's say 5-10%. If they're looking to sell that exposure, that could leave the rest of the fund with additional income. So a special distribution is a way for us as the ETF manufacturer to ensure that investors, both big and small, earn what they deserve, both in terms of income, but also potentially as a tax liability based on their holding period. So these special distributions generally protect smaller investors from the negative impacts of large investor transactions. So when a special distribution is announced, this is generally the most common context, and it's done to protect our investors and ensure that everyone is paying and earning their fair share whenever they hold ZMMK or any of our other ETFs for that matter.
Yeah, I think the issue that we saw was that some data providers that only pick up the last distribution were calculating the distribution yield based on just the special distribution, but not the whole distribution in the month of July. So the yield looked like it dropped, but in effect, it was just a calculation error, and you'll see it'll bump back up once August distribution comes out.
Yeah, so no changes to the underlying portfolio, no changes to the expected yield. It was more so a way to make sure that a exiting investor was paid their fair share, so that that tax liability, that income, wasn't left for the rest of the pool to absorb.
Makes sense. Okay. Final thing I want to touch on, you joined maybe 2 months ago now on target maturity bond ETFs, but I think this is still a great way for investors who are still feeling cautious to really navigate these types of markets. So just touch on target maturity bond ETFs again for us.
Yeah, target maturity bond ETFs can be a very useful tool for investors who want some certainty around their return, but also some certainty around the timing of their cash flows. I think these ETFs provide diversified exposure while acting like a bond. So you're getting a benefit of an ETF by that diversification with an expected return over an entire holding period, much like a bond, and a set maturity date. So you know when you're getting your money back. And I think this resonates with a lot of investors. And this enables investors to opt to ensure, am I going to earn an attractive yield over this period of time? Am I taking any individual idiosyncratic risk? No, you're not, because you're getting diversified exposure versus an underlying bond. And you don't need to worry about redeploying that capital in volatile markets. And I think these ETFs can be an excellent way for any investor who's looking for a little bit more certainty from their investments, but also those who may be saving for a specific time or an event. So I look at it, are you looking to buy a house, or maybe it's a new construction build that you're buying that's going to close in 2 years from now? Saving for education, one of your children is going to university, you have their RESP, but then you have this as an additional investment as well. You could time that to the starting of when you may need that payment. Retirement, if you have a specific retirement date, you can have this, you can use one ETF or you can use multiple ETFs that would ladder out. So you get a specific cash flow. You'd know what that expected return would be. There's certainty when you're going to get paid back. So I think that the use cases here are very real use cases, and it's using your investment portfolio to help you live your life day to day. And I think that's what these target maturity bond ETFs do, is that they provide you with that return certainty. They provide you with your cash on a specific date, and you can plan around those type of things. And I think that's very important for this specific investor base. And it's why target maturity bond ETFs across the industry have been such a successful and well-adopted tool.
Yeah, definitely a great innovation in the fixed income space. All right. Thanks, Matt. That was a great discussion. I appreciate you joining me as always.
Thanks, Erin, for having me. Really appreciate it.
That's all for today. Thanks to our viewers for tuning in. We'll be back next week where we're going to be introducing our new human capital ETF from BMO ETFs. We're going to be digging into really what this is and how it fits within a portfolio. And I'm going to be joined by our partners at Irrational Capital on next week's show. So I hope you can join us then. Thanks again, and we'll see you next time.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.